go now to Charles Sizemore, Chief Investment Officer at Sizemore Capital Management. That firm has more than $111 million in assets under management. Charles, great to see you. Let's start today, Charles, with the economic headline of the day. That was that PPI print, hotter than expected. I'm curious, Charles, you saw that headline. What did you make of that report as a CIO, Charles?
Sure. Well, the first thing to remember is the PPI number is notoriously noisy. It tends to be a lot noisier than, say, CPI. That said, when you see a core PPI number that is the highest it's been in almost 4 years, that's really a wake-up call. Now, where it gets more interesting is when you dig deeper into the data. The first thing anyone's going to immediately think is, oh, this must be the tariffs finally showing up in prices, right? Actually wrong. We still have yet to really see much of an impact from the tariffs. Most of the surge in the PPI was due to a surge in the cost of services. Now that could be tied more to immigration. We have had an estimated 2 million immigrants self-deport in the first half of this year. So that clearly exacerbates an already tight labor market. But yeah, that number is certainly not one we wanted to see. It also changed the calculus for the rate cut. So if we had had this conversation yesterday, I would have told you that the market was pricing in a 100% chance of a rate cut in September and a 10% chance that the Fed cut by 50 basis points as opposed to just 25. Now, today we're seeing very different numbers. There's been a swing where we're still seeing a 90% probability of a rate cut, but about I guess it's been revised to about a 7% possibility that the Fed just sits tight and doesn't cut at all.
Charlie, let me get your take. Let me get just your take on a different way to look at things. I'm curious to get your perspective on this. You get the PPI print, Charles, and as you said, not what you wanted to see. It was hotter than expected, and yet I look at the market response, Charles. We are flat across the board. It is a giant yawn. In fact, I look at the SPX. We actually ticking modestly higher here into the close. I wonder what message the markets is sending me there, Charles. Could it be, I'm going to bounce this off of you, that the markets could be telling me, you know what, maybe we're actually going to be fine. Maybe the economy's okay. It's, to use a word we've used a lot on this show, it's looking resilient. What do you make of that?
Well, the biggest story this earnings season has been earnings. The U.S. market, led by the tech sector, really is killing it right now. Earnings have been really good. And a single month blip in the PPI doesn't really change that. Now, we still have very significant risk, of course, but does 1 month of PPI that it could be statistical noise, does that really change the earnings picture? No, it doesn't.
Jay Powell speaking at Jackson Hole. As a CIO, Charles, you're going to be listening. What are you listening for there?
I would not want that man's job. That talk about a thankless job. We're looking for any indication of what his plans are. He's hinted that probably a rate cut in September is likely, though he's hedged his words to where he gives himself a little bit of wiggle room there. We're looking for really any indication that he's going to do anything other than cut rates by a quarter point. Any indication he might cut by more, any indication he might hold off for a bit, and then some guidance as to what he sees for the rest of the year. But I know that he's as confused as the rest of the market right now. Powell is anything if not transparent, and he's the first one to say he doesn't really know what to expect. He's taking the data day by day.
So, Caleb, I want to bring you in. What Charles is saying, when Powell speaks, he's listened for, does the Fed chief say anything other than, hey, I'm going to cut by 25 in September? What are you listening for?
Yeah, he's not going to say that. We know that for sure, but he's going to start to say that we're starting to see evidence of the potential impact of what tariffs can look like, but we need more data. We'll get more data between now and the next meeting, and he'll go back to fly fishing. What I'm curious, though, for you, Charles, you talked about earnings and the strength of earnings, and that definitely has been one of the propellants of the market. But as you look at the metrics within the earnings, we know a lot of that's top-heavy in AI and mega cap tech, but what are the key metrics that you're focused on to tell you that this is actually a healthy earnings season across sectors?
Well, no, you made a good point. It's extremely top heavy. The Mag 7 and the handful of AI driven stocks, they're pulling everything higher. If you look past those, it's a much weaker picture. But it really boils down to what matters today. The Mag 7, the core, it's not really the Mag 7 anymore. Call it the top 10 or so tech stocks. Everything moves based on their movements. They move the market higher, they move the market lower. Nothing else really matters right now. What I'm concerned about in the quarters ahead, of course, is that those companies run out of steam, as perhaps we see some overcapacity in parts of that story. But in the immediate short term here, it's just we live and die by the Mag 7. We live and die by big tech.
Charles, so let's finish here. Add it up for us. Given the backdrop, the environment we find ourselves in, Charles, your clients come to you. They're looking for advice. What are you telling them, Charles? Broadly, how do you want to be positioned here?
We are being more conservative than usual. We are keeping a little bit more cash than usual. We are keeping some hedges in the portfolio, but the fact is the market's trending higher right now, and there's no reason to fight that trend. This will eventually run out of steam. Like all booms eventually, reach their limits. We're not quite there yet. We may hit that limit this year, early next year. We'll see. But for now, the momentum's strong. We should participate in that.
Charles, good to see you as always. Thanks for your time.